Because we've got this 1,200-point rally, truly incredible, ended on our highs. But are you a buyer?
Remarkable, right? So, listen, I'm not going to pretend to say I saw this coming or any percentage of this coming today. But what we talked about on Friday, and I know it because it was only a few days ago, we said, look, you can take some solace in today's action on the fact that a couple things happened. The market has bottomed on days where the VIX is traded somewhere between 35 and 40. Obviously, we got that in spades on Friday. And we also pointed out, if you go back to September of, I think it was 2018 or so, Friday's close basically was the resistance level of the levels we saw back in September right before the market sold off. So we flagged those levels. Now, again, I didn't see today coming by any stretch of the imagination. So what's next to answer your question? Well, today's the recent low of 28.55 in the S&P, the recent high, the all-time high of 33.93 on February 17th. A 50% correction puts you at 31.25, so 1% from where we closed. I think it's reasonable to think that we'll rally tomorrow towards those levels and then fade on the back of what should be continued selling.
So if you think about today, not only did every asset class work, but you also got, this dynamic when markets start panicking, policymakers start planning. So this whole concept of coordinated central banks. And once again, we can sit around being real frustrated about what central banks can actually do here. We can be frustrated about how the Fed has created this, basically the market is there's a lot of terms I won't use in terms of how the market needs to respond to the Fed, but that's where we are. What's very interesting, or I think the dynamic here is a lot of folks come in today, they tune in tonight and they say, oh, wow, is this December 2018 when this was a V-shaped recovery? And here we are in a dynamic where we're truly looking at the economy, and we don't even know the extent of where the coronavirus is. So I think investors, again, prone to go back to the old playbook. I'm not sure this is V-shaped. I don't even want to get out there with that one way or the other, but that has to be where investors are right now because this all happened so fast.
And let's be clear, Tim, and I want you to follow up on that point because, and again, we're not throwing water on this. This was an amazing day. A lot of people made some of their money back, and that's good news. But here's the thing. If you look at all the data, okay, half of the biggest gains that we've had, point or percentages, also come in
during
bad
difficult
times.
Markets.
2008,
Yeah.
2009, we can go back to the 80s, whatever you want. Was there an element of panic buying today, which in many ways is not healthy?
Look, there's no sense. There was a lot of panic buying. There was a lot of panic selling. Markets were at a 9 RSI on Friday midday. They hadn't been that low even through the December levels. We know how oversold we were. This type of a bounce shouldn't surprise anybody, but these events come in difficult and dangerous markets.
If you look at the top 5 biggest percentage gainers of the Dow in history, all 5 of those came in 2008 and 2009. And the point is, in bear markets, you get these nasty rallies. I don't know if this is a bear market or not. I don't think there's enough information out there for anybody to know that at this point in time. But you can get these nasty rallies. I think the next thing you have to look for is the G7 coordinated call tomorrow, because it's really difficult to stand in if they are going to have coordinated central bank action and some sort of coordinated fiscal stimulus, which is ultimately, in my view, kind of the economic governmental response to all of this. That's really hard to stand in front of as a short. If anything is anything short of that with what they do tomorrow, then I think the market fades, like Guy's saying. So I think tomorrow's a real critical day. I would just say, if on Friday afternoon you were looking to dump out of your portfolio, why not take a little bit off at these levels after this rally?
I hate days like today. I mean, even though I'm long, last week was a disaster. This is not healthy, right? Companies, the value of companies did not move 5% today. Sentiment changed, right? And the oversold that Tim's talking about was, nearly
absurd.
Thunderous, crazy,
absurd,
right? So this kind of action I don't really like. There was a lot of things to like for the market to go up. There was a lot of fuel for the fire. You had coordinated G7. You have the expectation of a big Fed move. I think even Klobuchar dropping out of the race and throwing her support toward Biden helped the market.
Biden bounce?
The Biden bounce, absolutely. To the extent that Bernie is weakened, I think that's better for the market. So there was a lot, I guess, to like. I'm not a buyer on a day like today. I'd rather be a seller and risk being even more bloodied by the end of the day.
A lot of people buyed into the markets, as my southern relatives might say, Guy Adami.
No question, but you look and you would think, all right, the market's up a historic level in terms of Dow points and S&P points probably as well. Yet the VIX still has a 33 handle, I believe, which, if you had asked a couple weeks ago, people would have said preposterous, it's never going to trade there again. Yet here we are for a day like today. Again, it's interesting. I'm glad you mentioned it because everybody, when the markets go down like they went last week, it's always panicked. The market's panicked. Just if you want to give that, that's fine. You know what? The panic was there in spades on the upside as well. It's not fundamental on the way up and panicked on the way down. You have both up and down.
And we had some data points today, and again, a lot of stuff floating around, Guy, where people on Thursday and maybe Friday bought some of these double and triple inverse, market short bets. I wonder how much of today was that recovery.
Can I say something about those things, first of all? And with all due respect to the companies that have built those things, those ETFs are really dangerous. You can play them in the short term, but if you play them and you actually use them tactically for any meaningful period of time, the amount of erosion in the underlying position, I think, is very dangerous. I would also say that I don't think these are markets you want to trade. I don't think these are markets you want to step in and step out based upon what you think is going to happen. And we've seen this so many times. I talked about where the closest market allegory or analog I saw was August of 2011 when we were downgraded from the AAA in this country. You had huge problems in Europe. Basically, you had this kind of a dynamic in the first 8 days of August. Then you had this thing where markets went up 6%, down 6%, up 6%, down 6%, and finally had a wicked rally into the end of October before dumping people right back where by the year end. This is an environment where markets are trying to figure out what the global impact of this. Look at the PMIs that came out across Asia this morning. China had a 35 manufacturing PMI. I know that's the center of the storm. I know that's probably an aberrant number, but I don't think you should be in there trying to trade this. And I think those triple levered ETFs are very dangerous for most people.
Well, and to your point, Tim, on what's going on in China, we know that number is likely lagging. So you say, okay, fine, the factories are going to get back up and running. But now the question is, and again, you don't know the answer to this, where's the demand going to come from? Is Europe now shut down? What's happening here in the U.S.? Are those the demand factors that are going to slow down? And even if those factories in China get back up and running, who are they producing products for? That's the part that I think is unbelievably difficult to tell at this time. And it's really difficult to trade this market because you just have zero information.
Yeah, and by the way, I'm looking down because I'm reading an email that we got from Bob Bassani, who might come on. It's his Daily Trader Talk. It's fantastic, as always. $984 billion changed hands today, according to Goldman Sachs. The volatility, my point is on the upside and the downside. And some people got stressed out. In fact, I'm not going to pick on Robinhood, but Robinhood was down for most or all of the day. And if you
Didn't that happen to them the last time we had a big
I think it happened to Betterment.
Well,
yeah, but my point is,
sorry, Robinhood.
Those folks, and I don't know how many there are of them, a couple 100,000 or a couple million, they were unable to participate in this day. And so there's another.
Might have saved them from themselves.
Maybe, but there's a risk. There's a risk to these high volume days where we're learning that there are risks in other ways. Extreme price moves, right? Extreme reactions. And maybe some technology fails.
Well, extreme reactions. I mean, again, getting back to global central banks coordinated to do what? What exactly? Is cheaper money going to somehow stem the tide of people traveling? Just anecdotally, you talked about it before. You were supposed to be at a conference over the next couple of weeks that's canceled. And I know I had a conference scheduled towards the end of March, which is at least 20-something days away, that was just canceled as well for the reasons we're talking about.
You guys get me. By the way, I'm sorry you were going to actually have a desk without me at the end of the week. I'm back. I will be here. Apologies for all of
because you're not traveling.
Exactly, I'm not traveling.
But do this. So let's connect the dots to the stock market, right? Because we're fast money. We'll get to Apple in just a moment, Karen. The reality is, Tim Seymour, Guy Adami, Karen Finerman, BK, myself, who cares, right? But we get on a plane, there's hundreds of thousands of us going to cities, spending money in hotels, restaurants, taxis, Ubers, whatever it is. That is economic loss. That is not, I'm not going back. I may go back to Houston, but I can't go back in time. And we don't know how this is going to impact the E side of valuation, price to earnings. What are earnings going to be? How long is this going to go on?
We don't know, but I do think companies will get a free pass for probably the first quarter and the second quarter. and then we'll see. I mean, we talked last week, you said, why wouldn't every CEO out there be, guiding down or removing guidance? Any of that makes total sense, because they really don't know, for one, and why not give yourself a little bit of room?
But back to the multiples and the valuations, I mean, the other side of all this is that money is free. And in fact, your valuation based upon a discount rate, which is often priced off the 10-year, is now priced off of a 115 10-year. And that gives equity multiples an enormous amount of play if you want to do that. And let's be clear, this is in a world where central banks are pushing us all out the risk curve. This is a dynamic where equities become very, very attractive, especially those big companies that have a lot of room to do what they need to do in capital markets, including buy back stock.
But they're only, and I think this is what you're saying, but they're only attractive because rates are so low. That doesn't mean they're attractive because the fundamentals are good, which adds to the complexity here, because you could actually have, you have economic effects of this that are greater than necessarily the health effects. That's not to minimize the health effects of it. But if everybody starts to cocoon and everybody starts to quarantine themselves, then you have a big economic shock here in the U.S. But at the same time, right, if you have stimulus, fiscal stimulus, global central bank stimulus, you can have the stock market go up, the economy going down, and confusion all over the place, which is why I think it's good that people aren't trading.
That's good to say. Listen, the stock market is not the economy.
Can I say one thing? Because it sounds like we're being kind of negative on an up day, and maybe we're being negative on down days last week. What's very positive is that today, I would argue that the news flow around the coronavirus was worse. And you have a dynamic where I think investors have had a chance to digest the economic impact. The entirety of the unknown is out there for us all. But markets were able to find a little bit more rational on an irrational day, a little more rationality.
Yeah, good stuff there. And I think, Tim, everybody's being fair. I mean, it's better than just saying, hey, great day, everybody start buying stocks. You can't do that. I mean, so I think a little bit of skepticism right now is a very healthy thing.